We have Jonathan Miller of Miller Samuel, and well, it's good to have you with us. And you know, we're just talking about housing with Professor Ratsinas at Harvard, and also talking a little bit about the S&P Case-Shiller data. You say it's really all about the tax credit expiration.
Yeah, I really think it is. When you think about the Case-Shiller index that was released today, it's a November report, which essentially means September closings, which means June, July, August contracts, which was the tax credit expired April 30th, and that period we saw a huge drop in pending sales and activity during that period. So I think we're reading about what's going on and we're seeing things slip, but it's related to the tax credit. I agree with Professor Ratsinas that we essentially artificially elevated sales activity in the first half of 2010. We artificially depressed activity in the second half, and the difference is what we're sort of wrestling with right now.
All right, and one area, though, I got to mention that has not been hurting, that has no relationship to the tax credit, is luxury real estate, and particularly one piece of luxury real estate in the West Village of Manhattan, a $20 million townhouse that apparently has been bought by Sean Parker of Napster and Facebook fame, portrayed by Justin Timberlake in the movie The Social Network. Is this typical of what's going on in places like Manhattan or in places around the country that have this high-end luxury real estate? I know it's got multiple garage and its own indoor swimming pool.
Right. It's about 7,500 square feet.
Six stories, 6 floors.
Right. We believe they paid all cash. And if you look at sales activity in Manhattan over the last, sales over $10 million are becoming, I don't want to say common, but we had about 25 sales in the fourth quarter, 10 million and above, and 25 in the third quarter. So it is a fairly active market, but compare it against the peak of the market, 07, 08, when it was not uncommon to see 50 or 60 sales in excess of $10 million.
So when you look at the market right now, Jonathan, you see more luxury or do you see more low end? Because in the report you talk about how the bulk of the sales seems to be coming in, let's say, 2 bedrooms. People want more space.
Right. So what we saw in 2010 was a rebound from 2009, which I characterized as really the year of the first-time buyer, and that was a phenomenon across the country because of the tax credit. The entry level market is the first to come back in after a correction because they're interest rate sensitive. Interest rates were falling. That was what characterized the market. This year we had sort of a rounding out of the market. In other words, the high end of the market, the middle end of the market woke up, and we now have a more normal distribution of activity. If that's normal, I'm not sure, but that certainly is something consistent with the past.
All right, now people live in other places other than Manhattan. Tell me about what's happening in Brooklyn right now. It seems as though at least the amount of inventory that's on the market isn't huge. So as a result, you're seeing some real prices.
Well, what you're seeing, and this is true across most of at least Queens, Brooklyn, and Manhattan specifically, is you're seeing inventory relatively tight. And I'm not talking about shadow inventory,
real inventory,
resale, where product is on the market, seller lists their property for sale. Inventory levels right now are consistent with the averages we've seen over the last decade. So we don't have an excess supply of inventory if you don't factor in shadow inventory, which would be stalled new development from luxury condos that came on board during the boom.
My guest right now, Jonathan Miller of Miller Samuel, talking about real estate in the metropolitan area. Jonathan, we talked a little bit about the high end in Manhattan. You talked about inventory in Brooklyn and in Queens. Where are the best bargains right now in the 5 boroughs?
You know, because this was a credit correction and it really impacted the region fairly universally in the beginning. Right now, the market that seems to be performing the best continues to be Manhattan in terms of price stability and sales activity. But the outer boroughs, which I think there's a tremendous opportunity because there's a correlation with the tax credit. What we saw was greater impact or weakness caused by the expiration of the tax credit when the tax credit expired, meaning that when those were pulled from the market, we saw a larger degree of fallout in the outer boroughs, and therefore that's going to impact prices. So I
was looking at your report for Queens, for example, and it seemed as though that was a little soft market.
Yes, so what you're looking at is sales activity generally year over year off about 30%. However, a year ago at this time was sort of this end of 2009, release of pent-up demand in this region. The first-time homebuyer tax credit was in full force. And in fact, the fourth quarter a year ago, which we're making comparisons against, in most of the areas in this region were actually the busiest fourth quarter in several decades relative to their other quarters in the same year.
I noticed in your report you say don't necessarily compare this quarter with the same quarter a year ago. Compare it with the quarter just prior, because that will give you a little bit more of an accurate idea of what's really happening.
Right, as long as you factor in seasonality, because fourth quarter historically tends to be the weakest quarter in terms of sales activity and in terms of price direction. And that's what we saw this year. So after considering seasonality, we're pretty content with where the market is relative to where it was 2 years ago.
What about New Jersey and the suburbs of New York? Are you seeing price stability there?
Yeah, you are seeing price stability, but it's very fragile. So I think what you're seeing in especially Fairfield, Westchester, and Northern Jersey is you're seeing we're starting to leave this sort of post-tax credit period. I don't mean to harp on the tax credit, but it really created tremendous volatility in housing figures. And I think as we go into this year, this quarter was going to be the first period where that's going to be removed from the equation, and we're going to see how the market really is.
What about the counties on Long Island?
Long Island, same phenomenon that we're seeing in Queens and Brooklyn, which is a fairly sharp drop in the number of sales. Prices relatively stable. Same sort of idea. This is what we've been seeing for the last couple of quarters.
All right, so we're going to have to see what happens, because that tax credit seems to have created all these knock-on effects that we're still feeling.
It wreaked havoc, really, in the statistics in 2010. I think we're going to see less of that in 2011.
Jonathan Miller, thank you for joining us.
My pleasure.
From Miller Samuel, giving us your take on real estate.